Hey guys, welcome back to AAGS.online, or our YouTube channel, I guess. But anyways, I am coming to you guys today to share some more seasonal investing tips. I am going to give you a very specific timeline and a very specific pick, but this is also going to be uh, kind of a general information and some seasonal trends that you may want to incorporate into your, regular annual investing, and just to kind of give you some times and some trends that we have seen and spotted and that I personally use. Now, the information is not coming from me. I'm not the only person that has noticed this. I'm not any kind of like prodigy that realized this all on my own. It comes from books, kind of a conglomeration of things. And then one main book that has given me a lot of great detail on this. I don't want to give you all of the tips because I kind of want to promote that book as well. Just kind of, I'll lead you there. I'll give you the information. I'll give you as much as we can to give you one specific pick or time period, and then from there, if you want more, I'll link the book in the description below. But seasonal investing, if you're not aware, it's really my bread and butter. It's where a lot of my investing knowledge comes into play, and it's kind of what I like to do on an annual basis. A lot of people like to stay out of seasonal investing. They don't believe it. They don't believe you can time it, or they don't like. Maybe they'll do it, but they'll do it just kind of to play with. They don't really want it like in their IRAs or anything like that. It's not, reliable enough. My retort to that is typically there's really nothing more reliable than seasons. You're going to have the same four seasons every year. The same things get bought and sold at basically the same time periods. If you go into Walmart, if you go into any major retailer, I guarantee you they have a seasonal section, and it's probably close to the front door. That's because seasons work. This is what people do. This is a very reliable strategy. As far as exact amounts, you're going to profit 50% every year. Maybe not. Um, I know last year I recorded it on AAGS.online, my first year of actually recording the profits and margins and when sold and bought things. We ended up with a 47% increase or gain for the year, an unrealized gain, or I'm sorry, realized if you have non-IRA accounts. Either way, though, great gain, good year for us. This year has been really off to a lot of the same. The one sell that we've had already this year was about a 20% gain, and the first buy that we had for the year is already up, I believe, 60% last I checked. So go to the website if you want more information on that. It's aags.online. More to the point of this video, I have identified an amazing time period coming up. I'm going to do this video very early to give you lots of time to try and kind of strategize and get the most out of this time period as you can, as well as get as much money as you can together that you're willing to invest before this great time period comes up. There is what's called seasonal scoring, meaning that you have like a grading system basically. So certain times of the year, it's going to be really good to invest seasonal. Sometimes it's going to be really bad. The way that this grading system works is it goes from -1, which is your absolute worst. That's basically when you want to short the DOW specifically. And then it goes all the way up to a 5. And theoretically, you can get over a 5. But really, you're only going to get over a 5, and maybe even really to a 5, like once a decade, maybe twice, depending on how the years line up and things like that. But for the most part, a 5 is just about a perfect score. If you're above that, you need to really go all in with leverage and options and calls and everything you can. But anyways, so for this year, the peak of this year when it comes to seasonal strategies, it's going to score out at a 4, which is really good. I mean, that's obviously it's not as rare as a 5, but the 4 it's hard to come by. We're looking at maybe like once a year that it comes around. For 2021 specifically, this time period is going to be from November 22nd through January 6th. And the 4 points that go into this, they all obviously kind of correlate. So number one, you have holidays. If you are not aware of this, holidays are a great time to be a seasonal investor. I will be the first to say, and I think you'll read this if you kind of start going around and looking at different seasonal strategies. There's not a specific reason that holidays make the stock market go up. The kind of general consensus belief is that it's just kind of like the euphoria that comes along with holidays. You know, yes, there is increased spending, but a lot of times throughout the year, there's increased spending and we don't see the reaction to that in the stock market right away. It takes months before you see the spending or the earnings reports comes out and things like that, and you don't typically see such an immediate impact, but in the holiday season we do. So that's one of them. A lot of things, obviously increased shopping and just kind of getting ready for next year. As far as companies are releasing different reports and expectations, and everything is great in the holiday season. Usually you have a lot of companies say we're going to do awesome. We have these great sales going on. We have Black Friday going on. Holiday shopping's up. Next year expectations are going to be X, Y, Z, and everything's going to be amazing. So that's number one. Great point. There are some, there's a particular window around holidays that you want to, focus on a couple days before, a couple days after. But like I said, I don't want to give you all those specifics. If you're looking for that, you really want to get you to the book. It's not my book by any means. It's called Seasonal Stock Market Trends by Jay Capel. It is on the screen here if you're looking for it. And like I said, I'll put the link in the description. It really goes into a lot of detail on a lot of these things I'm about to talk about. Actually, I believe he touches on all of them. But that's number one. So number two, specific days of the month. There are particular days of the month that are better to invest or be in the market than others. This one does have more of a definite reasoning behind it. So typically towards the end of the month, you see a lot of people that get paid either at the end of the month, specifically, like they get paid on the 30th or the 28th if that's the last day of the month. And those funds get invested into 401ks and IRAs and things like that. And essentially at the end of the month or the very beginning of the month, because it kind of lingers over, you have this flood of money coming into the market. And I don't care what anybody tells you, that somebody can say it's expectations, it's earnings, it's a great product, it's whatever. Just like gambling and like a casino, money is what moves the market. I don't care what else is going on. If you have large amounts of money flowing into the stock market, the sheer buying pressure is going to push the prices up on the stock market as a whole in the case of the end of the month. Because it's just about everybody, whether you get paid bi-weekly or you get paid, at the end of the month specifically, like I know a lot of government personnel does, that money goes to your IRA. These huge floods of money come in, pushes the market up. The second time of the month that's really good, again, for investing or having your money in the market is about the middle of the month, which, if you're looking at the screen, for December in particular is going to be about December 13th through December 16th. And again, that's a lot of the same reasoning. People get paid on the 15th, or if you're getting paid bi-weekly, it's going in around that time frame for December, which is usually when we would expect to see a little bump in the price. Now, we're going to combine this with the holiday seasoning. So if you look at the end of November, you have the end of the month coming up, and you have Thanksgiving spending, or Black Friday spending, I should say. So those two things are really going to perk up the market. This year in particular, and this is not on the screen, this is just kind of my own belief or feeling, and we'll see how this plays out. But you have a lot of people that did receive stimulus checks, or they're going to receive the earned income credit, child care credit, just different money that has come in that, there's a good chunk of people that either kept their job or didn't need to use the full amount of their stimulus checks. And so those things are either invested or saved, and that money's going to come into the market. And if it doesn't come into the market this summer, it's going to be in the holiday season. Now, whether that's in the form of investing or that's in the form of just spending for holiday spending, it's going to come in there. There's going to be a wave of money that comes into the market. You're going to see it happen. So we're going to put those things together. The next thing on the list here is the November to May rally. And you may have heard this before, or seen something in the past saying is sell in May and go away. And that really, I believe, is changing. But the reason it's big for the Dow is the summertime is usually when big investment companies or big investors kind of go away. They're off on summer vacation, summer break, spending time with the kids, whatever it is. So a lot of times that saying is true. They sell all their stuff in May, or maybe they just put a hold on a lot of things and they just kind of go away and leave it there. And without these big investors and industrial investors, there's really not a lot of money to move the market. Yes, we do have our 401ks and things like that still coming in, so that's going to have a little bit of play. But it just overall, you're taking billions of dollars off the table that's no longer being, transitioned in and out of the market daily or hourly or however frequently they're doing it. So throughout the summer months, we usually have a lull in the stock market, and if anything, it goes down or maybe it's neutral if it's a good summer. That being said, though, from November to May, kind of going along with the holiday season, as well as everybody's back at work. Everybody's, they're working for the holidays, if nothing else, to try and have some money there. They're trying to kind of wrap things up. You have a lot of people investing in a lot of big money coming into the market. It's always been a good time, and really, I shouldn't say always, since the 50s, it's been a good time to be in the market is from November to May. So that we're going to add to a point here. So we're up to three things now that are kind of working in our favor. Lastly, there's what's called the 40-week cycle. Every 40 weeks, the stock market does go through a cycle. It's not a formal cycle, so it's not going to be, on like wallstreet.com or anything like that. But if you just go back and dig through history, every 40 weeks, we typically see the first 20 weeks be really bullish, and then it kind of transitions right after that, and then the next 20 weeks are pretty bearish or neutral at best. And this happens all the time, and it's not there's not a specific reasoning for it. It's just the way that the market goes. It's kind of got ebbs and flows, just like anything else. You have people come in, they put a lot of money in it, they have a lot of opportunities that they see that they really want to kind of gear their assets towards, and then they start taking that money out, taking their gains, selling it, and if nothing else, they just stop buying, and without that buying pressure, you see the prices, again, either remain neutral or slip. So that first 20 weeks is really good. Second 20 weeks, at best, is neutral. That 40-week cycle, the buy cycle for the end of this year, happens to be from September 24th through February 11th, which obviously captures the other points that we've talked about. So we come up to a total of 4 different points working in favor of us, and there's nothing that's working against us throughout this time period. The only thing that you can maybe speculate on or be kind of worrisome is COVID, if that were to kind of reappear in the same numbers that we saw last year, and there's a cause for the market to decline or for companies to cap how many people they can serve or how many people they can come into their businesses and things like that. That's obviously something you want to be aware of, but that's something that should not be unheard of. It shouldn't blindside us. You shouldn't wake up one morning and say, oh, wow, there's, COVID went crazy today. It's going to be a gradual thing. And if you see that, you can make some adjustments. On that same note, though, we saw the stock market do really well last year in the middle of the pandemic with everything going crazy, with really a lot of questions still unanswered at that point. So I'm not too worried about COVID. Even if it were to come back, I don't think it's going to be harmful to the market, at least not as much as you would think it would be. And a lot of that is mainly because we have some answers now, because there are vaccines, because people, understand that, mask wearing or mask not wearing kind of does dictate some numbers and how bad these pandemics can get. So again, it's just really the market gets scared when there's uncertainty. We have at least some of the answers to COVID now. It's not a new thing anymore. I don't really fear that COVID bump unless it gets extremely bad, and hopefully it does not. But again, that's just something to just keep in the back of your mind. Overall, though, we have 4 points working for us. My personal assumption is that throughout this time period, you're probably going to see a 15 to 25% gain. There are a lot of other points and factors that we can look for, and we can try to build a score. Like I said, that grading system goes up to 5. So there are ways to get above this 4. Again, I don't want to go into all of those. If you want more information on that, take a look at the book. I believe it's $20 or $30 now on Amazon. It's not terribly expensive. At one point, it actually was a textbook, and it was believe $70 for certain classes. So take a look. It's worth it. It's worth the time. It's worth the money. It's not a hard read if you have interest in stocks. I promise you, you'll find it informative. You'll find it very enlightening and kind of giving you some sort of certainty as far as timing of the market. Again, you're not going to time it down to the day and the hour, but you're going to have at least a window where you're going to feel kind of confident that, okay, yeah, this is a good time to pull the trigger to put some money into the market, and vice versa, time to get out of the market or short the market if you're really aggressive. So, in saying all this, I do hope that a lot of you would join me in investing in the Dow. I'm personally going to be leveraged. I'm going to be holding UDOW, which is a 3 times leverage for Dow. It can be risky because you're going to have, again, 3 times, whether it's good or bad, I'm going to get the triple effect of that. So some of you may be okay with that. Some of you are going to be a little more risk adverse. That's fine as well. If you want to just invest in the Dow or an ETF that matches the Dow, that's all fine. I just wanted to let you know that this is going to be a good period of time to be in the Dow. Find a way to get involved in it. If you don't want to get involved in it, you don't believe that the system works, by all means, just, if nothing else, be cognizant of it. Watch it. Look at what the stock market does throughout this time period. And just for some context, the seasonal strategy that I have and the point strategy that I used has been looked at and kind of historically referenced going all the way back to 1930. So it's 91 years. And throughout those 91 years, the average annual return is 22% per year. Per decade, it comes out to over 500% of a gain per decade. Now that's being aggressive, that's using leverage positions, and that's also shorting the market when we believe it's going to be bad. But still, that's the strategy I use. It's not like this is something that's only been around for 5 or 10 years. I mean, we're talking up almost a century now of information. So it's a good sample size that I'm pulling from, comparatively to things that you might see that were great this year, this decade. So again, hopefully you'll join me with either the Dow or the UDOW from November 22nd through January 6th. And if you have any questions, feel free to reach out to me. You can find me on Twitter. I'll put my Twitter handle in the description, or go to the website. It's aags.online. I will have another video with a specific stock instead of an ETF or kind of a tracking ETF. I will be giving a specific pick. We're going to line up some of the positions that are within the Dow and kind of see which ones best match this time period. And then we can really drill down to one particular position. That way the cost is much lower. The benefit can be higher. And if we really wanted to, we could even do some options, some calls on that to make sure that we get the biggest bang for our buck for the least amount of money. So just stay tuned for that. I'll have that here as soon as I get some information. Again, we still have plenty of time. We have roughly 8 months, a little bit more than 8 months at this point, to kind of get everything in order, have the money ready to invest, and have a great holiday season. But again, thank you guys for checking out the video. Please leave me a comment below. Subscribe if you want to make sure we're getting all the tips out to you, that you're going to have some information for stock market, seasonal trends. But again, aags.online. If you want to visit us, have a great day and good luck.